This is part two of the book module for, and we're going to work some problems here. This comes from page 445 of your textbook. I'm going to do these first four exercises. So exercise 4-20. What we're going to do is we're going to compute this cash conversion cycle. And if you'll remember, the cash conversion cycle is the days inventory outstanding here, and the days sales outstanding minus the days payable outstanding. When we sum that all up, we get the cash conversion cycle with that. So that's what we're going to do here. And so they very nicely already figured the average accounts receivable, the average inventory, average accounts payable. So we just have to do calculate those for both Halliburton and Schlumberger, and we'll go from there. All right, so got the fan going here. Okay, so the days inventory outstanding. So we'll do Halliburton and Schlumberger. If you're from around here, you know it is the burger. Okay, so the days inventory outstanding for Halliburton, the average inventory is 2712. And the cost of goods sold is going to be the same. Your book here says cost of sales and services. Now, this is one of the things that you need to be careful of when you're reading somebody's financial statements. They may call it slightly different. So cost of sales and services is the same of cost of goods sold. Obviously, Halliburton and Schlumberger are in the oil service business, and so cost of goods sold, cost of services are essentially the same thing with that. Okay, so our cost of services is 21,009. And so we calculate that. And we get 0.129 or 12.9% if you want to do it that way. Either way is acceptable. Now we need to multiply that by 365. And we get 47.12. I'm going to round that at 2 decimal places. So for Schlumberger, the average inventory was 4028, and the cost of sales and services was 28,478. And that equals that's not right. 4028 and 28,478 divide will be 0.141. Again, we multiply that by 365. That's the days part. And we get 51.63. Okay, so the next one is the days sales outstanding. And our With that, we're going to use the revenues. The accounts receivable. The average accounts receivable is 5135, and that is divided by our sales, which is the same as total revenue, 23,995. So is 0.214 times 365 is 7811. For Schlumberger, our average accounts receivable is 7983, and our sales is 32,815. And that equals 24.243. And again, we multiply that times 365, and we get 88.79. Okay, our next one is the days payable outstanding. Our accounts payable is 2,786, and our cost of goods sold, same as it was up here, 21,009. Is 0.133. Again, we multiply that times 365 for the days, and that gives us 48.40. Okay, for the for Schlumberger, we're going to have 10,103, and our cost of goods sold, cost of sales and services, 28,478. Is 0.355 times 365 is 129.5. Let's see, I do that, so 0.49. Did that to 2 decimal points everywhere else. I'll be consistent. All right. And so then we have our cash conversion cycle. The cash conversion cycle equals 47.12 plus 78.11 minus 48.40. In accounting, brackets means minus. and we get 76.83. For Schlumberger, it is 51.63 plus 88.79 minus 129.49. And that is 10.93. All right, so then the question continues here. Which company better manages its accounts receivable? So when we look at the day sales outstanding, we see 78.11 versus 88.79. So in that case, Halliburton does a better job managing the accounts receivable. The less time is the better. Which company uses inventory more effectively? So the day's inventory outstanding, you want the least. So once again, Halliburton has the least, so that's best. Which company manages its accounts payable better? So in this case, the accounts payable, the bigger is better, right? And so Schlumberger manages the accounts payable better. All right, so that's exercise 4-29. Our next exercise is 430. It says compute the measures for the DuPont aggregation. Below is information from 2018 for 3M Company. Compute the return on equity. So return on equity, we're going to use the net income attributable to 3M shareholders. We're going to use we'll use the return on net income attributable to 3M shareholders. So that is 53.49, and then the equity attributable to 3M shareholders is 97.96. So if we divide that, and we get an ROE of 54.6%, 0.546. So that's an excellent return on equity. And so we want to compute the components for profit margin. So profit margin, if we go back here, is the net income attributable to shareholders divided by sales. So profit margin is going to equal the 53.49 divided by 32,765. And that's going to be 0.163 or 16.3%. The next thing it asks is our asset turnover. Asset turnover equals the sales 32,765 divided by our total assets, which is our average assets. So we have the 36,500 plus 36,500 plus the 37,987 plus divide by 2, and we get 37,243. And that will be 0.8797 or 880. We want to round it to 3 decimal places. And then we need the financial leverage. All right, so the financial leverage is going to be the average assets. We just did that. And so okay, so our average assets is the 37,243, and we divide that by the equity attributable to 3M shareholders is 9, the average equity. So we've got 9,796, enter, 11,563 plus 2 divide will be 10, 679.5. So 37,243 enter divided by 10, 679.5 divide equals 3.48. So we're pretty highly leveraged. And then we compute the ROA is going to be our income, 32,765 divided by our average assets, which we calculated here. 30. No, I'm sorry. I did sales. I need income. Net income is 53,49. Now our average assets, 37,243. That equals 14.36% on that. Okay, so that is that problem. Third problem that we're going to do here, exercise 4-31. It says compute the gross profit margin for each year, and then we have to compute the separate profit margins for each section. So as we see, we have revenue, and it's divided into subscription, product, and services, and our cost of revenue, same as cost of goods sold, same as that cost of services that we saw with Halliburton and Schlumberger. Cost of revenue here, subscription, product. So we can get the total gross profit margin, gross profit, and thus the gross profit margin, and then we can get the segment gross profit for each of those. And so for the first one, our gross profit is 15,441, and that's divided by our total revenue of 17,606, and that gives us 0.877. That's a pretty healthy gross profit percentage. And then it asks us to do for each one. So subscription is 16,388 minus the cost of revenue of 646, subtracts, gives us 14,742 divided by the subscription revenue of 16,388 gives us 0.8995, 89.95%. For the product, we have sales of 532 revenue and cost of 35 is 497 divided by 532 equals 0.9342. And then finally, we've got services and other. And our revenue there is 686 minus the 484. So that gives us 202 divided by 686 equals 0.2945 on that one. And so then it asks us what explains the company's gross profit margin levels. Well, anything that is a service is going to be high, and this so the subscription is going to be the high, and the services and other. So it's all in the cost of revenue or cost of goods sold there. Okay. And then the last one I'm going to do here is compute ROA and the adjusted ROA. So the following information was reported by Yum Brands in its 10K. Use this information to answer the requirements. Compute the return on assets for each year assume a statutory tax rate of 22%. All right. Okay, so in 2019, our ROA is going to be 1294 divided by the average assets of 4681. That's just given to you. And so that'll be 27.6%. All right, so let's take a look here in your book. See what they ask for adjusted ROA. The adjusted ROA, the adjustment we're going to make is the interest expense. So we're going to take the interest expense and multiply it by 1 minus the tax rate. Okay. So what that does when you do that is it assumes what your so it's this 1 minus the statutory tax rate is taking out the tax effect of that when we do that. All right. So when we go here for the adjusted ROA, we're going to have the net income again of 1294 plus the interest expense of 484 times 1 minus the statutory tax rate. Statutory tax rate is 22%, so 1 minus that is 0.78. And that is divided by the 446.81 that we had here. So 484 enter 0.78 times, add the 1294 and divide that all by 4681. And we get 35.7%. Okay. For 2018, we're going to have the net income of 1542, average assets 4721, and that's going to be 32.7%. For the adjusted ROA, we're going to have the 1542 plus the interest expense of 496 times 0.78. All that divided by 4721. $386 plus 1542 gives us 1926.88. Divide that by 4721 gives us 0.40 for 40.9%. And so the question is, then the question of that is, what managerial insight does adjusted return on assets offer as compared to the usual ROA metric? So it basically tells you how much your interest costs are eating up in your returns. So that's just one way to look at that. All right, so those are kind of a look into ratios, and good luck on your module 4 homework.